Hey guys, hope you are doing well and welcome to another new video. In our previous video we talked about home loan. So there is lots of things that people ask on Google about home loan, and I appreciate that to research about this and then take this service. Most of the people, those people who want to make a home for their family, for themselves, they mostly those people have any don't most time those people don't have any money to make a home. They can take a loan from bank to make their home, to build their home. Okay, so how you can do this? You can go to a financial institution, then you can apply for a mortgage or loan. If they approve it, then you can get the money. That's all. It is a simple procedure actually. Okay, in our previous video we talked about actually underwriting. Today we will talk about mortgage. Okay, how mortgage work. Individual and businesses use mortgage to buy real estate without paying the entire purchase price upfront. The browser replaces the loan plus interest over a specific number of years until they own the property free and clear. Mortgages are also known as liens against property or claims on property. If the borrower stops paying the mortgage, the lender can foreclose on the property. For example, a resident home buyer placed their house to their lender, which then has a claim on the property. This ensures the lender interest in the property should they by default on their financial obligation. In the case of a foreclosure, the lender may evict the resident, sell the property, and use the money from the sales to pay off the mortgage debt. The mortgage process would be a borrower begin the process by applying to one or more mortgage lenders. The lender will ask for evidence that the borrower is capable of repaying the loan. This may include bank and investment statement, recent tax return, and proof of current employment. The lender will generally run a credit check as well. If the application is approved, the lender will offer the borrower a loan of up to a certain amount and a particular interest rate. Home buyers can apply for a mortgage after they have chosen a property to buy or while they are still shopping for one. A process known as pre-approval. Being pre-approval for a mortgage can give buyers an edge in a tight housing market because seller will know that they have the money to back up their offer. Once a buyer and seller agree on the terms of their deals, their representatives will meet at what called a closing. This is the time the borrower makes their down payment to the lender. The seller will transfer ownership of the property to the buyer and receive the agreed upon sum of money, and buyer will sign any remaining mortgage documents. Types of mortgage. Mortgages come in a variety of forms. The most common types are 13 years and 15 years fixed rate mortgage. Some mortgage terms are as short as 5 years, while others can run 14 years or longer. Stressing payment over more years reduce the monthly payment, but it also increases the total amount of interest the borrower pay over the life of the loan. The following are just a few examples of some of the most popular types of mortgages available to borrowers. Fixed rate mortgage. With the fixed rate mortgage, the interest rates stay the same of the entire terms of the loan, as do the borrower's monthly payments toward the mortgage. A fixed rate mortgage is also called a traditional mortgage. Adjustable rate mortgage, ARM. With an adjustable rate mortgage, the interest rate is fixed for an initial terms, after wise, it can change periodically based on preventing interest rates. The initial interest rate is often a below make rate which can make the mortgage more affordable in the short terms but possibly less affordable long term if the rate raises substantially. ARMs typically have limits or caps on how much the interest rates can range each time it's adjusted and in total over the life of the loan. Interest-only loans. Other less common types of mortgage, such as interest-only mortgage payment option ARMs, can involve complex repayment schedule and are best used by sophisticated borrowers. Many homeowners got into financial trouble with these types of mortgage during housing bubble of the early 20th century. Reverse mortgage. As their name suggests, reverse mortgage is very different financial product. They are designed for homeowners 62 or older who wants to convert part of the equity in their home into cash. This homeowner can borrow against the value of their home and receive the money as lump sum, fixed monthly payment or line of credit. The entire loan balance becomes due when the borrower dies, moves away permanently or sells the home. Average mortgage rates 2020. How much you will have to pay for a mortgage depends on the types of mortgage, such as fixed or adjustable. Its term such as 20 or 13 years. And interest rates at the time, interest rates can vary from week to week and from lender to lender, so it's pay to the shop around. Mortgage rates are at near record lows in 2020 according to the Federal Home Loans Mortgage Corporation. Average interest rates look like this as of the August 2021. 13 years fixed rate mortgage is 2.87%, 15 years fixed rate mortgage is 2.15%, 5.5 adjusted rate mortgage is 2.44%. A 5.5 adjustable rate mortgage is an ARM that maintains a fixed interest rate for the first 5 years, then adjust each year after that. How to compare mortgage? Bank, savings and loan association and credit union are virtually the only source of mortgage at one time. Today, a burgeoning share of the mortgage market include non-bank lenders such as Better.com, Loan Depot, Rocket Mortgage and Sophie. If you are shopping for a mortgage, an online mortgage calculator can help you compare estimated monthly payment based on the time of mortgage, the interest rates and how large a down payment you plan to make. It can also help you to determine how expensive a property you can reasonably afford. In addition to the principal and interest you will pay on the mortgage, the lender of mortgage may also set up an escrow account to pay local property taxes, homeowners insurance premium and certain other expenses. Those costs will add to your monthly mortgage payment. So that's all about our today's video. If you like this video, then don't forget to subscribe our YouTube channel to get more videos like this. Thank you very much for watching.